Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Alex Luck, welcome back to the podcast.
Thanks, Owen. Great to be here.
We've got a bit of a medley soup of questions, some tangly ones, some fun ones. We've got HECS, should it be repaid? We've got questions about moving into a share house when you already own a property. What's the diff between managed funds and ETFs, insurance, and this new policy from the government to tax super funds over 3 mil. We're going to cover all that in this session, thanks to some great questions sent in from the community. If you do have your question on the tip of your tongue and you want us to answer it, send it in via the link in your podcast player. It says ask a question, select the Australian Finance Podcast, and we can get Alex back to answer some of your questions next time he's passing through Melbourne, because he's a native of WA. So welcome to Melbourne.
Thank you. Don't hold that against me.
Don't hold it against him. At least not until the next AFL grand final with the Freo or the Eagles. But
long time for
that's going to be a little while, we think.
Yeah.
So that means you're in friendly territory today, and we're going to answer these questions. The first one, Alex, is about HECS, and it comes from Owen Rask, which is a bit of a play on words, let's be honest. Don't know what they're talking about. I've heard a lot of general financial advice that says HECS debt is something that should be low on a list of financial priorities, including from the Barefoot Investor, they say. I have started uni this year and I'm staring down a huge mountain of debt I will have to pay off when I graduate, and I'm aware it is taken into consideration when negotiating for mortgages. I think they mean getting a loan. Would you, generally speaking, recommend making voluntary contributions to pay down HECS? Or would investing/saving into a high-interest savings account be a wiser choice given the indexation rate of HECS? And so I want to just quickly insert something I've forgotten, which is the general advice disclaimer. Alex is a qualified financial advisor. You can find him on the ASIC register, but we don't know your needs, goals, or objectives. So any of these questions we're going to answer in a general fashion. And keep in mind that we don't know those things, so you should reach out to a financial advisor before you act on any of the information you hear. The reason why we ask for funny question and names is so you understand, again, that we're speaking in general terms. Check out the Rask Group's Financial Services Guide, available at rask.com.au/FSG. So, Alex, the question is, HECS pay down or not to HECS pay down?
Or not to HECS pay down. Yeah.
What do you think? You have a lot of clients that deal with this.
Yes, we do. Because I guess the demographic that we deal with, a lot of our clients often have some form of HECS debt. Mm-hmm. And I think within this question, the person has, or Owen Rask has kind of sort of, answered it themselves as well, in terms of like why it is a low priority. Yeah. Because typically, HECS is just, indexed at the CPI or the inflation rate on the 1st of June every year. They do that. And the reason why that's important is because that is typically the lowest interest rate sort of form of a loan that you're ever going to get. So if you've got other debt commitments like a mortgage, or you've got
car loan,
credit card, anything like that, that's always going to attract a much higher interest rate than what you're technically paying on your HECS as well. Mm-hmm. Likewise, as they've sort of mentioned here, generally you are going to be able to get a better return or interest rate on, let's say, a savings product or a high interest savings product as well. So it's sort of, I guess, the what you're looking at, I guess, is that almost like arbitrage opportunity or opportunity cost of, if I pay my HECS off, with additional payments versus if I put that into a high interest saving, like you would technically make more money in the high interest savings account. So I think it just comes back to like what your priorities are. So we discuss this with clients, quite a bit. A lot of the time, to be honest, like it's psychological in that they just hate having it hanging over their head. So if that is you and you're listening, and even though like mathematically it makes less sense to pay that off, I would still pay it off because
it makes you feel better.
That's right. If it makes you feel better, then you are just going to feel better. Like it is then going to improve your cash flow technically, depending on what you're earning as well, because less money will now be held back from your employer to allow sort of for that HECS debt. But yeah, I guess a hypothetical option in this example would be, say you did want to sort of pay it off, you could put money aside into that high interest saver, and then you could make a voluntary contribution generally before the 1st of June, so you don't get hit with the indexation on the full balance. Important to note as well, obviously with the new government that's just come in, because what's the date today? Recording this on the 27th of May. Labor is proposing some changes in legislation to how HECS is sort of treated.
Yep.
So looking at potentially reducing 20% off all balances in the new financial year. So that's obviously going to help a bit.
That'd be handy for me.
Yeah, you'd have a bit of a...
Oh, yeah.
So I think it said, or what I read was it was going to save about 3 million Australians on average, about $5,500.
Wow.
By doing that. So it's quite sizable.
Yeah.
And there's also another proposed change within that as well in terms of at what income level you have to start paying that back. So currently it's about 56, well, once you earn more than 56 grand, you'll have to start paying that back, your HECS, whereas they're proposing to take that up to 67,000. So which is then, so again, lower income earners or people getting their first full-time job out of uni and stuff like that. That's going to sort of help from a cash flow perspective. But just bear in mind that because you start paying it back so you only now start paying that back on a higher income, likely the HECS will hang around longer. And it does obviously, as they mentioned, have some effect in terms of your borrowing capacity when it comes to looking at a mortgage or serviceability of those sorts of things currently too.
I think that's important for people that don't understand the basic of HECS. So HECS goes to paying off your uni degree. But the way you pay it back is through your salary. When you go to a new job and you tick the box, there's like 2 boxes that most people should tick. One is I have a HECS debt if you have a HECS debt, because the employer withholds a little bit extra and sends it to the ATO for you. Number 2 is, do you want to claim the tax-free threshold, which if you're not familiar, basically means that that's like the first component of your income that could be tax-free under the law. You obviously don't want to go around ticking that at every employer if you have multiple jobs, but for the first one, you probably do. So that's really important. Now I'm going to log in here while we're going through this and see what my HECS debt is. Because if they bring this in, I'm trying to figure out on the fly, thanks to what you've just told me, how much I could potentially save by the Honourable Labor Party getting into office.
Well, it hasn't gone through yet, but I don't think it's going to have any opposition.
One of these promises that's,
you should have voted Greens, because the Greens apparently wanted to wipe it entirely.
Oh, really?
And that would have really helped you.
Oh, well, I can't even see it because the MyGov app, which is where you find out about all this, has just said that my security is not good enough. So I'm going to have to return to this. But I think it's around about 60 grand I still owe.
Nice.
So, yeah. You can find out via the MyGov portal, which is you just get the app on your phone to identify and then sign in, and it's happy days. So that would be a real big kick for people.
And supposedly, from what I've read, which again, fact check me on this, given that it isn't technically legislated yet, is it will be done prior to the 1st of June. So it will be done retrospectively as well. So before that indexation of, say, your 60 grand, it'll be taken off.
Off the first amount.
Yeah.
So it doesn't go up as much.
Yeah.
Oh, wow. That's cool. Okay, cool.
So you get that almost that benefit as well.
Yeah. Elsie writes in, Elsie Belsie, and says, I've had a managed fund for 10 years, but I'm thinking of I could do better by putting it into an ETF. I want to use part of the money for a deposit, but keep some of it as an investment. They say in a disclaimer, I struggle to understand the pages of terms and conditions, and so I have no idea if I'll lose money by taking it out of the managed fund and plonking it, that's their word, which I like, into an ETF like the Vanguard Diversified ETF. Thank you for your podcast. It has been helping to demystify many things about money. So there's a question here within a question, I think, is what is a managed fund? How is it different to an ETF? Can you kind of demystify that for all of us?
Yeah, let's start with that, because I think, this is a question within a question. So managed fund is effectively a pooled investment. Okay, so it's a much older structure. I think I saw the other day, like the first mutual fund, as they're also called, was established in 1924, whereas the first ever ETF, I believe, was established in 1993 or 1994. So they are, their underlying holdings can be the same or very, very similar. Stereotypically, a managed fund will be more of an active style investment. So you'll have a fund manager, which has got a set of goals that they're trying to achieve, whether it's, outperform the Australian share market by X as an example. And ETFs more stereotypically will be more passive or indexed investments. So they just be the Australian share market and get whatever return that sort of provides. But there are some differences, which we're not going to go into the super technical side of it here, but I guess high level, an ETF generally is more tax effective just for the way that it's structured, whereas a managed fund isn't necessarily. Now, that doesn't mean that there's a reason that you wouldn't then invest in the managed fund. But for example, because a managed fund is that pooled investment style and you and I are in the pool together, if you want to leave, so you sell your shares in that managed fund, that's a capital gains event, which effectively, because it's a pooled investment, I'll have to pay capital gains on that as well in the event that you leave. Whereas in an ETF setup, I wouldn't necessarily cop that.
So you've got separate units that are created.
Separate units, yeah, that's right. So an ETF is just, I guess the way I would sort of, again, describe it sort of in sort of layman terms is, the managed fund is the horse and cart per se, and then the ETF is the car. It's just a more efficient mode of transport.
Both getting you somewhere.
But both achieve the same thing, right?
Yeah, just a different way of getting there. Okay. And then so they're suggesting in this that they might move into like a Vanguard diversified ETF, which there's a heaps of different ones. VDHG is the most popular right now.
Which technically is a managed fund.
Which, under the surface, people don't know this. It's a whole thing. But also it started because it's a whole thing.
Sorry, we won't pull that thread. We'll be here all day.
Yeah, so just generally, then like what are the considerations someone would want to take into account when they're thinking of making a swap like this?
So looking at this question within the question, it seems like effectively they're saying, can I get a better return, or is my investment strategy going to be better under an ETF? Okay. Now, really what it should be is like, what's the underlying assets that I'm holding? Because in the managed fund, to use my example before, they could simply be the Australian stock market, and then you could buy an ETF which does the exact same thing.
Right.
Okay? So what this person or this hypothetical person would consider is, okay, the underlying holdings in my managed fund, do they match my investment strategy?
Yep.
Okay, which might be like
growth,
high growth. I want to make as much money as I can in 10 years. Okay. In which case we're going to want to have exposure to stocks and property as an example.
Yeah.
Okay. So moving to an ETF, which does the same thing, is just going to do the same thing. Now it might be technically a slightly better tax structure per se, but if you've already got managed money in the managed fund, then you're potentially realizing a capital gain now by selling, because I'm assuming you've held it for a while.
Made a little profit. Yep.
Yeah. To then move into an ETF and then pay transaction costs for that to happen as well. So in that instance, it wouldn't be particularly smart to do that. You're better off just staying with the managed fund, and potentially maybe new money that you had to invest going forward from your cash flow. Maybe then you look at the ETF in that example.
Yep, that makes sense. Okay, cool.
But sorry, just to I guess finish that off. Again, managed funds can invest in the same thing as ETFs.
Yeah.
Okay. Again, but stereotypically, managed funds are active. Stereotypically, ETFs are passive.
Yeah, like you mentioned on the Vanguard website, if you go to like the Vanguard Personal Investor, you can have the managed fund version of exactly the same thing that's an ETF.
Yep.
So it's just about knowing what's actually inside it and does it match your long-term planning.
And often as well, managed funds can have way lower entry costs as well.
Yeah.
Than an ETF, because you don't have to go through a brokerage platform.
Yep. Dinesh asks, this is a really good one actually, and it's good that you're here to answer this one. Hi, Australian Finance Podcast team. I've recently started the investing after listening to your podcast. That's awesome, Dinesh. I got a question to ask related to my life insurance premium. There are two types of premiums, and they say step up and level premium. Step up sounds like a movie. It's kind of cool. Currently, I pay the step up premium, but I heard that it will go up drastically after I'm 50 or 55 years of age. Instead, my friend suggested that if we pay higher premiums from now using level premiums, It won't go up until 65 years of age. Can you suggest paying more level premiums now itself, which is higher? Is that a good idea? Or is it just marketing strategy by the insurance company? What are the drawbacks of the step-up premiums? So I want to just go back to basics here, right? Firstly, just tell us what a premium is.
Okay, so premium is the cost that the insurer charges you to have whatever underlying insurance you've chosen as part of that product, whether it be life insurance, total and permanent disability, TPD, trauma cover, or income protection.
So this is sometimes paid by super funds for some of it, and sometimes people just pay it out of their budget, like they just get like a direct debit or a BPay or whatever they pay it with. This is the actual cost of having the insurance that they want. Now, Dinesh has gone on to say that there are two different options. What are the two different options?
So it's called stepped, so not step up. That made me giggle a little bit, but but it's fine. There's so much terminology in this, people get it wrong all the time. So it's technically stepped, okay, or a level premium.
Okay, and so
what's the difference?
Stepped sounds like it goes up over time, unless they're stepping down. Most people step up, so sounds like it incrementally goes higher over time. Yeah,
so a stepped premium is effectively an exponential curve.
Right, so it curves up.
Yep. So if you think of a life expectancy curve, so you can Google that, you'll see that. So that's basically what I'm getting at there is moving from, say, age 18 to 19, the chances of, say, dying are very, very minimal between an 18 and a 19-year-old.
Yep.
Okay. But as you get older and older, i.e., say you're now a 70-year-old to a 71-year-old, there actually is often a material difference in the chances of that person passing away. It might be like another 2% or 3% chance as an example.
Yep.
All the way up to, I think 82 is the life expectancy of a male in Australia as an example, where it's effectively then a vertical line. Because if you're living past that point in time, you are now living above the average age. Mm-hmm. So that's how basically the premium goes, right? So not much of an increment in your sort of 20s and 30s. Generally around like sort of 45 to late 40s, you'll start to see sort of an acceleration in that curve, which will then continue to accelerate into your 50s very much and then into your 60s and so on. So again, it's basically a vertical line.
Which is why most retirees tend to start cancelling insurance. Well, not the only reason, but one of the reasons.
Yeah, that's right. So the other option you have, as I've described correctly, is what's called a level premium, okay? So here, basically, you're paying more money to begin with. Okay, so let's just say the step premium is $100. The level premium, say, is $150. Okay, so it's more expensive, but effectively, it's a flat line, right? So there'll come a point in time where the step premium is more than $150 than the level premium.
So you can choose to pay more now.
That's right. So effectively, you pay more now to pay less in the future. Is the theory.
Now we spoke a little bit about this recently. Even though it's called level, it can still incrementally go up, right?
Yes. So without sort of spending all day here, the insurers have had to make, they've had to make a legislative change quite recently in that they can't call it level anymore, okay? Because it always said in the PDS that they can increase the price of that if they need to, albeit it was effectively marketed as, you pay your $150 and that's what you'll pay, forever sort of going forward. Yep. So the very confusing thing now is they've all picked a different name for it. Okay. So I can't even tell you off the top of my head some of these names, but they've all picked a different name. And effectively, but it's got the word variable in it often now to, again, try and make it clear that we can actually increase the cost of this if we need to.
So it'd be like level in brackets variable.
Yeah, so for example, they'll call it like variable stepped and variable level, right? As an example.
Right, okay. To tell you that, yes, this one is more expensive now and it could go up if X, Y, and Z happen. Hopefully it won't go up like as much as the other one.
That's right. So, but to this person's point, like the way that they're thinking, I think, is logical in terms of the way that they've approached it. And they've said like, so surely it's better to pay more now because I'll pay less in the future. The issue with that is, it's like, well, what is that point in time? So when would you have actually been better off going for the level versus the stepped, okay? Which a financial advisor will be able to produce the projections from the insurer to sort of see that point. It's very important to look at, or what we always look at Everest Wealth, for example, is the cumulative difference, okay? So versus the actual cash flow difference.
Right.
Okay? Because I want to look at the cumulative difference because I want to know like, after all these years of paying more, at what point would I actually be better off, as opposed to at what point does the step actually become more expensive than the level in that year?
Right.
Okay, because that year might be, say, 8 years away. It's now gone from the steps now 160 and the level's 150. Cool, I'm better off by $10 that year. That was the crossover point. But that cumulative difference, because one started at 150 and one started at 100, might actually be 15 years in the future.
Because you've saved or, whatever.
Because, each year, you said you're paying $50 more in the first year, then the next year maybe it's $48 more, and then it's 30. And so you've got to add that all up, right? So you want that cumulative inflection point, not just the cash flow inflection point.
Yeah, that makes sense.
Does that make sense?
Yeah.
So then the issue you have with that, because often it is sort of 15 years, sometimes it's 25 years as an example, is we'd have to sit here and say, well, you're working with us on, and we do your insurance needs analysis, and we factor in, obviously your recently born son, and you're only in your early 30s, and you've got a mortgage, and yada yada yada. So we come up with how much we think you need, and you're happy with that. If we were to go level, really you're committing to saying that you still need that amount of cover in 15 years. Because if you're not going to hold it past the 15 years, you're not going to be better off.
Yeah.
Right. So that's the other thing, I guess, the other side of this to remember, because this person, when they've asked this question, has said, well, surely I'm better off just to go, well, they've implied I'm better off to go the level, right? Because it'll be cheaper when I'm 65. But you might not need insurance when you're 65. Hopefully you don't.
You might need more when you're 45.
Yeah, that's right. Your need will change generally over your lifetime. Stereotypically, when you're single, there'll be some need, and then you meet someone, you buy a house together, the need increases. Then maybe if you have kids, the need will increase a little bit more. But generally after that, it will start to teeter off, right? Because kids will get older, mortgage comes down, build more wealth, to the point where you cancel it. So that's where you've got to be very careful with, although it may be tempting to cool, I'll pay more now, so I pay less in the future. But it's trying to bring it back to but will I actually still need this amount of cover in the future for it actually to be beneficial to me?
So, you're a family man.
I am. Yeah.
And you are fully informed across all this stuff. What have you gone with?
So, I've gone with stepped predominantly. I do have with my trauma cover, which pays out for critical illnesses like cancer, heart attack, stroke as an example. People may not have heard of that one because you can't pay it through super, so they may not have seen it in the super fund before. I've got, I think I've got a couple of $100,000 or $250,000 worth of cover there, and some of that's on a level premium, and the rest is on stepped.
So you can have a bit of one and a bit of the other.
You can, yeah. And the reason I've done that, well, A, the cumulative payoff, I think, was in 7 years' time when I started it. And B, likely I am going to hold that longer term, right? Because my chances of claiming on something like that will increase into my 50s. So I guess the way I'm almost looking at it is even though I may not need to have that cover when I'm getting to that age, I hope I don't, I'll potentially still keep it because now my chances of claiming are 1 in 6, whereas, right now at my current age, it might be 1 in 30,000.
Yeah.
But everything else for me is on stepped, because I don't think I'm going to need, the $2 million I've got in TPD cover in another 15 years' time.
Yeah, fair enough. I like it. That's a great question from Dinesh.
If I can add one more thing, the other advantage of going that stepped option is I'm not tied into that insurer. Right? Because if you've gone level, right, you can't then move to another insurer and sort of resume your rate, if that makes sense.
Yeah.
That you have to again pay the entry premium again with that new insurer. Whereas under stepped, it is more of effectively a like for like comparison. So I'm now with insurer XYZ. 3 years later, do my insurance review. Nothing's really changed. Still need similar amounts of cover. Haven't had any health events. Okay, but now with insurer ABC, it's 30% cheaper. I'll just move across to them.
Yeah. Cool. I like it. Great answer. A great question from Dinesh. Just a Girl writes in, hey guys, I'm 26 and I bought a house 2 years ago. I've had a friend move in paying rent the whole time. So that's great. Helps cover the cost of the mortgage, but they want to move closer to the airport. This person might be from your neck of the woods. They're FIFO, fly in, fly out. So they would like to be closer to the airport and to the city, right? And they've got a chance to move in with friends. And they've been getting some mixed messages about renting it out, what they can and can't do. They say, is this a financially good idea or is it a silly idea if they move in with those 5 people and then, rent out that one? They say, quote, some real estate agents have told me I can get a lot of discounts and fees taken off because I've never rented out my house before, so all sounds good to me. But am I missing something? Is this too good to be true? I also got told I won't get capital gains tax unless I rent my house out for 6 years, which isn't the plan. I'm only wanting to move out for a year. Also, I can get stuff done to the house and claim some back on tax. End quote. There's a lot in this question. We'll probably only take the bits that we need to take. I'm interested in this number that she's thrown out, which is 6 years. I'm also interested in your thoughts on some real estate agents have told me ... And then there's the whole tax, generally speaking. We can only speak generally. Let's start with the real estate agents. They say that I can get some discounts and some fees taken off because I've never rented it out before. What is that all about?
Well, well, she has rented it out before and someone's already renting it.
Yeah, true.
First and foremost. So yeah, probably before we start this, like, seek your own tax advice, and everything that me and Owen are about to talk to now, like, we will not be held accountable for. It's general only.
A tax accountant.
That's right. But what they're referring to, I believe, is tax deductions when they're referring to sort of those discounts. So when you do have an investment, the costs of that investment are effectively tax deductible, i.e. if you're renting out a property and you pay council rates or water rates, you can claim that as a tax deduction, which comes off against your income or the rental income that you're receiving as part of that. So which is good.
I find it funny that they said get fees taken off because I've never rented out my house. I was like, I did not. Maybe I just missed this part of the question, but I was just like, what are they talking about?
Well, I think, that's what I'm assuming, that they're talking about, tax deductions. So from the fees perspective, all the discounts they've mentioned is, they're referring to, you got to pay your council rates every year to have that property. So that becomes a tax deduction if you are renting it out as an investment. I
would just say, just a girl on this, not to be too cynical, but definitely get the advice, not just from what you're hearing from here on the show, but you can pay an accountant to give you an actual qualified opinion.
Yeah, absolutely.
Like, don't take the real estate agent's word for it. No offense. Get your own independent tax advice.
Yeah, all due respect to real estate agents, at the end of the day, they're not qualified tax advisors. So whilst what they're saying could be true, again, they are technically not qualified.
The ATO, if you get it wrong, just a girl, won't be like, oh no, cool, the real estate agent told you.
Yeah, that's right. You can't fall back on that, unfortunately.
Okay, so potentially there's some tax benefits there. What about the idea of the 6 year thing here, Alex? So they've said that something about capital gains. So I'll get you to explain capital gains on a house, like their home, but then maybe we can just do lip service for the 6 year thing.
Yep, absolutely. So in Australia currently, your principal place of residence, so where you live, you don't pay capital gains tax on that when you sell it. So if you buy the house for $1 million and you sell it for $2 million 10 or 15 years later, there is no tax to pay on that $1 million gain that you've made.
Great.
Okay. On investment assets like shares or an investment property, when you sell and you make money or a gain as a result of that, you effectively have to pay tax on that gain.
Okay.
So that's a high level, pretty simple, I think, to sort of understand there. The 6 year rule that they're referencing here, and again, get your own tax advice. Effectively, there is a ruling which says that if it's your principal place of residence to begin with, so I've moved in and I've lived there for a couple of years, and then I decide to move out, say, and rent elsewhere and rent out my existing place, so now turn it into an investment asset.
Mm-hmm.
If that is sold within 6 years, so I get 5 years in and I'm like, yep, tenants are a pain in the bum and I just want to now sell this thing and I've made some money on it, I go and sell it. Because it's within that 6 years timeline and it was my principal place of residence to begin with, I can sell that and still not pay capital gains.
Okay, cool. So this is a really interesting rule for people, particularly in your demographic that work with you at Everest, is like young people wanting to be on the property ladder. I buy in, maybe say it's like an outer suburb or a less desirable area because that's what I can afford. But I know that that's good suburb in 5 or 10 years or whatever. But right now, based on my lifestyle, I don't want to live there. I'm 25 and free, baby. I want to live close to the city where the action is, so to speak, right?
Yep.
So this would be a really common thing for people to be like, well, if I move out and I'm a rent investor, then what happens to my crown jewel, which is my house that I've just bought, you know? And so that's where getting good strategy and planning, I think, really helps, as does the tax, having a good tax account to help with what you can and can't claim at what particular time.
Yep, absolutely. And again, reading into this question, it sounds like, I think there was a mention there that effectively what they can rent the place out for was going to cover their rent where they were going to live, or cover the mortgage, I think, per se. So it was going to be cash flow neutral or cash flow positive. So, in that instance, sounds like a pretty decent idea, right? In that they're 25 and free and they want to be closer to the city and the airport, and they can now effectively rent out this house that they owned and they lived in for a while, and come out neutral or slightly better off. Then potentially makes sense from that lifestyle aspect that you mentioned.
Yeah. For anyone listening to this, if you're thinking, I'm in a similar situation, maybe it's later in life, maybe you want to go and I'd love to live in like a place like Port Macquarie. I just love that part of the coast, nice. New South Wales, especially winter now. I'm just like, I would like go and live there for like.
How close is
months.
that to Newcastle?
Not that far. I think it's like, everyone's going to like call me out on this. I think it's like less than 2 hours.
Yeah. Because I've done a bit of the Central Coast, and it is beautiful.
Yeah. I'd love to go there, even like down south of Perth. Like, it's amazing. I'd love to just go and experience these places. But then I'm like, well, I've got a mortgage to pay. I'd have to rent that out, right? So like a lot of people would be in a situation where they're like, I would do that, but I don't know what the consequences are. So one, you can see a financial advisor. There's two different types, broadly speaking. One that can give you tax kind of advice, not tax accounting, but tax advice. That's like Alex here. And then there's like a tax agent, which does deductions and all that sort of stuff. That's your tax agent, like your accountant. If you're in the property scene, you probably want both, but you definitely want the tax agent to help do deductions, property depreciation, all that. So just a girl, find a good tax accountant that can answer these questions. You can pay them. You can say, hey, can I just pay you a few $100 and come have a quick Q&A with you? It'll be worth it. Final one, which is a bit of a can of worms if you're in the older demographic, but even as this questionnaire has alluded to, really interesting for everyone.
Yeah, I would say the younger demographic is
probably, yeah. I just have faith that people would come to their senses between now and the time that a 30-year-old is retired. But let's find out. Unrealized gain should allow unrealized loss. That's the questioner name. Is Labor's plan to tax unrealized gains in super over the $3 million mark, they say in brackets, what many have said it sounds like? And if so, how on earth can something like that even work? This is especially important to understand and work against, since this will be a problem for the majority of people in years to come, given it isn't indexed. So, Alex, firstly, we need to debunk some things about what the hell does unrealized mean. People have a general gist of tax. What then is this thing that Labor's proposing? And let's think about this from everyone's perspective, not just the retirees, as I alluded to. So first of all, what is an unrealized gain?
Yeah. So let's say you bought some shares of Commonwealth Bank for $100 and you bought them a while ago and they've since doubled in value. So now your investment is at $200, but you haven't sold them, right? So because you haven't sold them, that's what's considered an unrealized gain. Okay. Now, if you did sell them, it would become a realized gain of the $100 profit that I'm
and you would have then $200 per share in your bank account.
Yep, you get the $200 back now, 100 of the initial capital investment plus the $100 gain.
Yep, and that is what you'd pay tax on.
That's right, at that point in time. So traditionally, that's when you pay tax, okay? Even though, so not when it's unrealized, okay? Yep. So even though on paper you may have made that $100, because you haven't executed that sale or had that transaction, there's no tax to pay at that point in time.
It'd be like if you own property and you get that rates notice every year and they kind of assess the value of your house and they're like, your house has gone up $100,000 in the last year. And you'd be like, oh, that's great. That's unrealized because you haven't sold it. It's no like different. You're still living in the same house. Okay, we've crossed that hurdle. Second base, what is Labor proposing?
So it's Division 296 is what they're proposing, which they went to the election with. Where effectively what they've said they want to happen is anybody with superannuation balances above 3 million, any unrealized gains within those funds are to be taxed like they're realized. So to use your example, and maybe you would have a self-managed super fund worth more than 3 mil, or not you, but like, you know, in this example, I think it's only 0.5% of current super funds, but a lot of those, as we were discussing off air, are likely going to be self-managed super funds where they might own a very large commercial building or something like that. Because, you know, commercial property is often, you know, 10 million plus, 5 million plus as an example. So let's just use the commercial property as an example. So they bought it for $1 million, you know, 15, 20 years ago. Now it's worth 4 million in the self-managed super fund. So it's above the 3 million threshold in that example. They've made $3 million on that technically as a gain. Yep. So what Labor is proposing, even though they haven't sold that property in this example, they should have to pay tax on that.
Which is brutal.
Which the issues with it, which everyone's pointing out, which is perfectly logical, I think even at the layman level, is like, well, where do they get the money to do that? Because they can't just go and knock down a wall to get the tax that they owe to then give that over to the ATO. They would, in theory, have to now liquidate this asset to realise the 4 million to pay the tax that they've been told they now have to pay on the unrealised gain.
So then we start to think about, okay, people are just thinking, this is just an old rich person problem, right? But then everyone that's like, hold on a second, I'm a young person that contributes to super. They're saying that that $3 million level isn't going to change. The Greens, by the way, wanted to make it $2 million just in case everyone's playing along at home. I'm going to put money in my Australian super or Host Plus or whatever the heck I got going on. I'm probably going to have quite a bit of super when I retire just by doing the normal thing.
That's right. So the thing that people probably aren't talking about enough, which is why I sort of said at the top of this, I think it's more the younger demographic that should be more up in arms than anything, is they're not going to index this figure. So I read something earlier this morning, which I can't remember who it was, but an economist from AMP had run some numbers basically, and a 22-year-old earning the average wage in Australia, assuming a 3% wage growth over their lifetime between then and 65.
Which is very common.
Yes, very common, and likely will earn more. Like that's that's
conservative,
very conservative. At an 8% return, I think it was as well, which is within line pretty normal, pretty standard return. They would get above 3 mil by the time they got to 65 in that example. So that would then affect them. So the amount of people that will actually be affected by this in the future will be heaps, and they'll be the majority of the population. Because right now they're obviously continually sort of banting around like, well, it only affects 0.5% of all superannuation funds, which it does at this point in time. But because they're not going to index it, the average everyday, lady and man is going to be affected by this if you're in your 20s or 30s and possibly 40s.
So then the big play then you would have to say from the Labor Party is that everyone will be forced to, because there's no way people will be able to pay those bills, like just in no way. Because you can't also then like just go and put more money in if you're older and whatever. So then they'll have to sell, then probably move the money out of super, like they pay tax in there, then put the money in their own name, and then they pay tax at a higher rate. So Labor wants basically to say super wasn't designed for $3 million super funds at this point in time. It was designed for people to live a comfortable retirement, but not an extravagant retirement. That would be their rebuttal. So you need to sell and put that warehouse in your own name.
Which I think, most people generally won't have an issue with. The issue is more the lack of indexation of that 3 mil, because that 3 mil will become the average everyday man and lady's balance in the next, 20 to 30 years. So then everyone's then not going to allowed to have, that much money in super. So that's probably more the fundamental issue I personally have with it. Not so much the people that are going to get whacked with it now, because it's a tiny portion of the population. And they are obviously the ultra wealthy. So nobody generally has an issue with taxing the rich more. It's more just the flow-on effect of this. And that's what I think politically they're doing, in my obviously own personal opinion, is they're hiding behind like this doesn't really affect anybody other than the ultra rich, which is true as of right now, but it will affect the everyday person in future years to come. Probably like another point to make on that, I guess, from the practicality, coming back to the taxing of unrealized gains, is what you're going to potentially have is, say you have a situation where, you've got let's not even use the commercial property. Let's say it's some unlisted shares in a startup company. Okay.
Because you can use your super to invest in a startup if you want to.
Yeah, that's right. So you might have a self-managed super fund. I buy money, buy some shares in a startup, and I buy them at $1, and now they're a tech company and they've grown like crazy, and now they're worth $400 each or something like that. So I've made this huge unrealized gain, 3 or 4 years later. So my choice is either to sell that, okay, in that example, in which case I may not want to do that because I feel this company is going to continue to sort of keep going. In which case I have to pay it from somewhere. So say I take it from cash out of my self-managed super fund to pay for that, which then what that does in terms of my overall asset allocation, okay, because it might have only been 5% of my allocation, that unlisted, because it's very risky. Now that's going to grow as a result because I've paid using very safe assets in cash in that example. Furthermore, what could happen is because it's a startup, 5 years later, it might go to zero.
Yeah.
In which case I've paid this huge unrealized gain on something I never actually got to realize.
Yeah.
So now it's gone to zero, it's gone bankrupt. I've just paid a whole bunch of tax in theory for no reason, which obviously like you then get a carried forward loss or a tax credit, but I might never make that money again to ever offset that credit. So yeah, it's very hard. Again, I'm probably getting a little bit personal here, but like, I think, it's very unfair. I just don't understand the logic of it. A, from a practical reason, and B, it just doesn't really pass the pub test in my opinion.
It's like brinksmanship. It's like a Donald Trump move, maybe. Like come out with the craziest, stupidest idea and then offer the alternative, which isn't as bad.
Well, I think that's like you said, the logic is they basically want to get more money out of the superannuation system.
Yeah. Surprised their industry fund friends did let them do that. But it's generally, I don't know, I'm curious on your perspective, because everyone that listens to this, like we're all kind of like pro-investing, pro-growing wealthy to support our families, our communities, our friends. We kind of believe in those ideals. A lot of people that will never listen to this podcast are the ones that this vote is appealing to because they don't understand. But do you consider this like a broad structural shift that's underway in Australian society, which is most people don't seem to like people that grow wealthy, which is a shame because a lot of those people grow wealthy by solving society's problems. But do you think it's like fair to say that over the next 10 years, we're going to see more things like this?
Yeah, I think so. I think basically, I mean, we could spend all day on this at the end of the day. But yeah, fundamentally, we have to pay for things ultimately, and we've got a shrinking working population, so less people paying tax. Superannuation has now become this incredible beast and just a huge sum of money, of which a lot of it is untaxed. So the government has ultimately looked at that and gone, well, we can't tax the 20s and 30s and 40-year-olds guys, up to 90% of their income. Like that's just never going to fly. So we've got to get money from somewhere else. Hey, we've got, over $1 trillion or whatever it is in super here. Let's put some things in place to either tax that more or effectively create policy, which means they have to move it out, or they're going to be incentivized to now move it out of that lower tax structure into higher tax structures, which is their own name or something else.
Yeah, I just feel like this is a really blunt one for people. I feel like it's going to really hurt people like farmers.
Well, and the problem I see with it,
people that are just like not
coming back to that,
going to be able to sell.
The startups, right? The venture capitalist sort of stuff is like, you might have this awesome idea, which is going to solve, one of society's problems. But it doesn't make sense for me to invest in it. Because if I do, I'm just going to get taxed the nines of money that I don't have to pay for it because it's going to be on that unrealized. So therefore, you go, well, I can't get any funding to get this idea off the ground. I'll go I'll go somewhere else. I'll go offshore. I'll go to America or somewhere else where they are more pro-investment to do it. And
yeah,
so you might see a lot of leakage of innovation and stuff like that leaving Australia too.
Yeah, not to mention all this I mean, eventually it might just cause issues like around people. Like in the warehouse example, you can't just get up and sell a warehouse in a day. And if you tried to, you would get virtually nothing for it. So it's an interesting one and one that's going to evolve. I think there's still some really good tax optimization that good financial advisors and accountants will help you with, things like family trusts. Because
even in that warehouse example, like to riff on that, right, is like, you've got like a medium-sized business, okay, and the owner created their own self-managed super fund 10 years ago to buy their own warehouse of which their business operates out of, okay, and now it maybe now has the valuation of the 5 mil or something like that. So it's like, what do? Like at the extreme, they've got to sell it, okay, which may create other liquidation problems, in which case that business is potentially now vulnerable, in which case potentially that maybe goes under as a result, and then you've just basically got 50 people which just got fired as a result because of this policy that they put in place to try and get money out of something which is completely illiquid, which they haven't sold.
Yeah. Well, you can all agree, as you said, that we don't really think that super needs to have 100 mil for people in there. Some people it will. I think it's just about being reasonable in the way that we go about these rules. And just to continue on that thought from before, there's definitely ways that you can optimize your tax position. You got super, different assets that you don't buy and sell. Like the big fear of people here is, I'll continue on that train of thought, insurance bonds, family trusts, investing in your partner's name, whatever the case may be, farming incentive schemes. There's so many different things. The big fear amongst everyone should be not just indexation, but also, well, if they did it to super, where else are they going to do it?
That's right.
Because then the whole system is fried. We're kind of immune to them coming out with harebrained ideas in the parliament that then get passed straight through the Senate because they're both houses are both Labor at the moment. So then no one really challenges it on the way through.
It's a big problem. So we could talk about all day that all Western sort of economies are facing. I think it was last year was the biggest ever net migration of basically professionals from Western economies to other places, like Dubai and stuff like that, right? Because they're all kind of facing similar problems in that they've got a shrinking working population that tax needs to fund the pension of, the baby boomers per se, which is not their fault either, because they were told basically, do this and we'll look after you. So we can't get, annoyed at that. But at the same time, if they continue just to raise, personal tax rates or create these other things, like the incentive for myself and yourself and a lot of people listening today is going to be, why will we stick around? Like, we're working super hard and most of it's just getting taken off us. Yeah.
So, what a way to end the podcast. We talked
a little bit of a downer, wasn't it?
We talked about HECS. HECS is a good thing for the society in general, but it's yet another thing that needs to be repaid. But it's a good thing because, as Warren Buffett said, one of the best things that ever you can do is invest in your own education, because you have your own inflation rate. If you become an accountant or you become a plumber or you become whatever skilled trade, you are going to earn more and more and more and more money from the original investment in yourself, which is at X. So that's great. And HECS is a wonderful system. Elsie Belsey says about the managed funds versus ETF, there's a few things that Alex said in there. One of the things was just know what you're investing in and then make a informed decision against your long-term strategy. Dinesh had a great question about step up / stepped versus level / variable / level variable premiums, which is great. But it's a really good point to consider, particularly if you plan on having a family and all those wonderful things, or you own a business, you just have liabilities, etc. You don't want to get sick and have no money. Just a girl asked about renting out. I think people that if you have a property and you do want to do this, go and speak to your accountant, go and speak to your financial advisor. Remember that 6-year rule, which is the one where maybe you can move out for a bit, rent it out. There is a time limit. The clock will tick, but it could be strategically advantage to you to be a property owner and live the life you want. Finally, we got started on the unrealized gain, $3 million put forth by Labor. That was a can of worms, as you can tell, and there's a lot of outrage across the internet. We didn't mean to contribute to, but it was hopefully a well-informed understanding for you of how laws will impact not just today, but long into the future. Alex Slack, financial advisor from Everest, you guys are doing great work, a long-time partner of ours. Can I say the favorite? Well, maybe.
You can say that, sure.
Everest Wealth, check them out. There's a link in your podcast player or on YouTube. You can find a link to get in touch with the team. Mate, absolute pleasure having you here in Melbourne.
Thanks, mate. Yeah, really appreciate it.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.